Ladies and gentlemen, good day and welcome to the Centum Electronics Q3 FY24 earning conference call hosted by PhillipCapital India Private Limited. As a reminder, all participants' lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I would like to mention a short cautionary statement. Some of the statements made in today's conference call may be forward-looking in nature. Such forward-looking statements are subject to risk and uncertainties, which could cause actual results to differ from those anticipated. Such statements are based on management beliefs as well as assumptions made by and information currently available to the management. Audiences are cautioned not to place undue reliance on these forward-looking statements in making any investment decisions. The purpose of today's earnings conference call is purely to educate and bring awareness about the company's fundamental business and financial quarter under review. I now hand the conference over to Mr. Bhavani Kumawat from PhillipCapital India Private Limited. Thank you and over to you, sir.
Thank you, Manuja. Good morning, everyone. On behalf of PhillipCapital India Private Limited, I welcome you all to Centum Electronics Limited Q3 FY24 earnings conference call. Today, we have with us management represented by Mr. Nikhil Malavarappu, Executive Director, and Mr. K.S. Desikan, Chief Financial Officer. Without taking much of your time, I will now hand over the floor to the management for their opening remarks, post which we'll open up for Q&A. Thank you and over to you, Nikhil sir. Thank you.
Good morning, everyone, and thank you to PhillipCapital and Mr. Bhavani Kumawat for hosting this Q3 FY24 Concall for Centum Electronics. I'd like to extend a warm welcome to all of you to this earnings call, and thank you for your interest in Centum and for making the time to join the call today. As a quick reminder for those of you who may be attending for the first time, Centum as a company is focused on the ESDM electronic system design and manufacturing segment and offers 3 service lines: EMS or electronic manufacturing services, build-to-spec VTS, which is a turnkey end-to-end service of design to mass production, and third is engineering R&D services. Coming to our results, on a standalone basis, before that, our standalone business itself is comprised of the EMS business and the VTS business for defense and space customers. And our subsidiary, which operations in Europe and Canada, is primarily focused on engineering services and some VTS work for customers in the railway and defense.
Nikhil sir, your audio is not that clear. Can you move the device nearby you?
Sure. Coming to our Q3 performance, we are happy to report consolidated revenue of rupees 298 crores, representing a growth of 51% year-on-year. This is due to increased revenue in all the divisions. Standalone revenues from operations is 176 crores, with an increase of 10% quarter-on-quarter and 72% year-on-year. At the subsidiary level, revenues increased by 30% quarter-on-quarter and 29% year-on-year. Our focus in the subsidiary remains on improving the margins. On the order book front, order book stood at 1,489 crores, which is slightly lower compared to the September 2023 level due to certain delays in booking orders in the build-to-spec business for domestic defense and space customers. So that's a quick summary. I will ask our CFO, Mr. Desikan, to cover the main points from a financial perspective.
Thank you, Nikhil. And once again, a warm welcome to all of you. At the outset, I'm happy to inform that we had a better quarter compared to the previous quarter and also over the same period in the previous year. First, let's talk about the quarter. At a consolidated level, the revenue from operation is 298 crores, which increased on a Q-on-Q basis by 20% and 51% on year-on-year basis. The EBITDA for the quarter is about 29 crores, which increased by 67% against the previous quarter of rupees 6 crores. Now going to the standalone for the quarter, the revenue from operations for the quarter was INR 176 crores with an increase of 10% quarter on quarter and 72% year on year. The standalone EBITDA for the quarter was about 22 crores, which is an increase of 6% as against 5.5 crores the last year same time. The PBT for the quarter is 15 crores, which is significantly higher compared to the year on year and quarter on quarter. Now let's look at the 9-month numbers. For the 9 months ended, the consolidated revenues reported are about 794 crores, which is a growth of about 31% year-on-year basis. And EBITDA was around 68 crores rupees, which is almost 2.5 times as compared to the last year's same period. EBITDA margin stood at 8.5% with an increase of 424 basis points. Net profit is at 4 crores and the working capital remained more or less flat at 137 days. The debt reduced by about 12 crores from the previous quarter, mainly in the subsidiary. So I'll stop here just quickly about the numbers and the financial performance of the company. Now probably you can open the floor for question and answer. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ankit Babel from Shubhkam Ventures. Please go ahead.
Good morning, sir, and congratulations for excellent set of numbers. A few questions from my side. So the orders in the BTP segment are getting delayed since last couple of quarters now. So just wanted to know the status of the same. I mean, that is, by when can we receive those orders?
Sure. Hi, Ankit, thank you for the question. Just to correct, the delay in the orders that we mentioned was in the BTS segment. So this basically is for customers in the domestic defense and space business. Yes, you're right. We've had a couple of quarters of delays in receiving this orders, but information we have is that it's at the final stage. We expect it to be cleared, imminently. So we are hoping to have this closed in this quarter, in Q4.
Okay. And so what could be the typical size of such orders? I mean, is it in the 100-200 crore range, or it's in the 400 to 500 crore range, or even more?
It's in the range of about 200 crores.
Okay. Now, given the fact that our order book is almost flat since last few quarters, now given the customer forecast and the visibility, Do you feel that it is still, 20-25% top line growth, which you have been guiding for next year and onwards, is possible?
Yeah. So a couple of things. First, to respond on the order book front itself. I think first, as we mentioned, we had, of course, this delay in the order on the build-to-spec side.
Sorry to interrupt, sir. Can you move the device nearby you? The audio is...
Yeah.
Yeah.
Is this audible now?
Yes, sir. It's loud and clear.
Okay. Yeah. So apart from the delay on the build-to-spec side of the business, which I mentioned, couple other points. One is that with the supply chain situation, reducing intensity now, components are more readily available on the market and so on. Customers themselves in the past were giving firm purchase orders for a longer horizon, are now coming back to a normal way of working where they will release a shorter horizon of firm purchase orders and give a forecast beyond that. So that would be one of the contributors. Apart from that also, we do see some temporary slowdown in a couple of our customers, essentially because of an overstock situation that they had following the supply chain crisis. That to some extent has been compensated. New customer additions and new orders that we've taken in from other customers. But we expect this temporary slowdown to recover again towards the end of this year. So with all that being said, I think we do see some risk in hitting like a 25% growth kind of level for next year. But having said that, on the other side, we do see our mix improving. We're taking several actions. So from a margin standpoint, we see ability to grow by more than 20-25%, despite this slowness in terms of the top line.
So my next question was on margins only. So how are the cost rationalization programs going on in your France subsidiary and Canada subsidiaries? And at a consolidated level, can we expect that 12% kind of a margins which you have been saying, say next year? This year you had guided for a double-digit margins, but next year around 12% margins is possible?
Yes. So in short, first to answer the question in terms of what we're doing, I think as you mentioned, we have a new CEO in the business that's been in place now for last 1.5 years or so. He's identified a very clear cost reduction plan to improve the cost and the margin by at least about 2 million euro at the subsidiary level for the next year.
Sir, your audio is not clear. I request you to move the device nearby you.
Okay. So I was just saying the progress on the cost reduction plans are moving. A plan has been identified for about 2 million plus euro cost reduction plan to be in process of being implemented, which will reflect in next year's numbers at the subsidiary level. That's one. And then the second point also is we do see an improved contribution also happening from the build-to-spec side of the business next year, which will give us some further operating leverage as well. And with all of this, we expect that we should be able to meet the 12% level for next year.
Okay, and sir, one small question to Mr. Desikan. The current interest cost run rate is around 7-8 crores on a quarterly basis, including all finance cost and everything at a consolidated level. So, which, if we annualize it, it comes to around 30-35 crores. What can be the interest cost in the coming years, considering the growth and the working capital and the CapEx requirements?
Yeah. I don't see any significant increase in the finance cost, basically because we are taking efforts to reduce the working capital levels also. Because as I have been mentioning in the previous calls also, wherever there is going to be an inventory increase, we are also seeking customer advances. So we should be able to maintain the working capital levels and thereby, bring down the debt also a little bit, if not a significant manner. But because of these reasons, definitely the finance cost will be more or less at the same level.
Okay. Thank you, sir. Thank you.
Thank you very much. The next question is from the line of Chirag Kachadia from Ashika Institutional Equities. Please go ahead.
I have a couple of questions to Nikhil and Desikanji. During the quarter, some of our domestic defense PSU clients like BL and HL in the month of December announced several deal wins and orders from Government of India from various departments. So when we expect that those will convert to our order book? And second, on certification and licenses side, have we applied for more certification so we can, bid for more higher margin orders from global OEMs and all? Yeah.
Yes. So, to address your point, in December there was a series of approvals from the Ministry of Defense for a long list of platform-related opportunities and orders which were announced. Those will, we do have a few different programs that we are a part of or engaged with as part of those announcements. We expect this for it to convert into orders to take probably at least 12 months or so, because it has to be converted into first orders on the public sector units themselves and then go through the RFQ process for vendors. So this will be at least a 12-month process, knowing the timelines of Government of India.
And the second question was on certification side. Have you applied for more certificates to bid more projects with global OEMs?
Certifications itself, in terms of, are you talking about the EMS side of the business or you're talking about the bid to spec?
On both sides, sir.
Yeah, certifications typically follow award of business by a new customer or a new segment fundamentally. So what we are seeing essentially is that in terms of our pipeline of new customers, we have a very healthy pipeline coming from multiple sectors, both from automotive and on the defense side of the business as well. We have the necessary requisite certifications in place to be able to address those new opportunities. Pipeline remains strong, basically.
Okay. And on aerospace side, due to this emission norm changes and many private aircraft and airlines announce, operating their fleet and all. So how are we looking at that opportunity for our defense and aerospace vertical?
Sorry, can you repeat that question?
Due to emission norms change and world over, many airlines upgrading their fleet of private carriers. So how are we looking that as an opportunity for our defense and aerospace vertical?
Got it. Yeah. So this is clearly a very important theme, of course, in the defense and aerospace vertical, but broadly in other segments as well. But to tell you specifically about the kind of opportunities we are working on, we have a ongoing program in the engineering services side of our business, where we're engaged with Airbus as the OEM on their future aircraft, which is going to be zero emission aircraft, basically. So we are working on this program with Airbus and continue to look at increasing our engagement and contribution of this program.
Thank you. All the best.
Yeah, thank you.
Thank you very much. A reminder to all the participants, you may press star and 1 to ask a question. Thank you. The next question is from the line of Karan from Nivesha Investment Advisors. Please go ahead.
Yeah, am I audible?
Yes, sir.
Yeah, thanks for the opportunity and congratulations to the team for excellent set of numbers. I have a question on the broader level, like, are you facing any issues related to the delay in orders, related to the raw material sourcing or exporting the orders in the Red Sea or the ongoing Israel war?
Sorry, so the line was a little bit muffled. If I understood the question correctly, it was regarding opportunities in terms of orders or anything as a result of the war in Israel, correct?
No, I'm asking that are we facing any issue related to the import of raw materials or export of our finished goods due to the Red Sea issue or the ongoing Israel war, like delay in orders or increase in freight cost?
Understood. Yeah. We are not seeing fundamentally any direct impact as a result of the war, either on logistics or supply chain related matters. So this is not something that we are experiencing today as an impact right now. We do see some opportunities as a result of increased spending happening there with some of our customers that we are engaged with. But this again will take some time to come into effect. But right now, in the current quarter and so on, we have not seen any impact as a result.
Okay. And also, like, are we facing any issue related to the demand or trade receivables on the export side? Because we are hearing that some of the clean tech companies in the US are highlighting delay in execution of orders or something. If you could, spread some light on the same.
No, we don't see any delay or challenges in realizing the export receivables. It's all going smooth. We don't see any issues.
Yeah, like I said, there's no issue on the receivable side. Where I did mention is some of our customers on the industrial side. We have seen a temporary slowdown in the demand as a result of overstock. But as mentioned again, we expect that to recover towards the end of the year.
Okay. And also just want to confirm, like, would it be safe to assume that we would be growing at revenue growth of around 20% that has been guided earlier, and the EBITDA margin in the range of 11-12% for the next year, like FY25?
What we have spoken about is more on a medium-term basis. As I mentioned, when we gave a guidance of 20% plus, we are talking really at a medium-term basis. We don't want to give every quarterly or yearly type of guidance. So that's just one point. as I said, for next year, we do see ability to grow. There are some risks that we are seeing with some of the temporary delays or push out of some of the orders by our customers as a result of this overstock situation. But over the medium term, we don't see this as a risk. The pipeline continues to remain strong, both with our existing customers as well as new customers in terms of new opportunities that we are bidding on. So the outlook still, I think on a medium-term basis, we are quite confident that we will be able to continue to grow at a healthy rate.
Okay, that's great to hear. And also a follow-up question, like, can you, would you be able to highlight the big pipeline in monetary terms or like the long-term contract that we have with the customer? Not talking about the 1-2 years, maybe long-term, like 5-6 years with the customers.
Typically, the engagement models with the customers are it varies again from the business to business. So as I mentioned, on the EMS side of the business, the way it typically works is we are awarded the business by the customer at a certain volume, and we typically have a period where we have firm purchase orders from them, and beyond that, a customer forecast. This can vary from a 12 to 18 month or 24-month kind of horizon. Where I'm talking about the forecast, basically. And on the build to spec kind of business, most of the build to spec business is project or PO-based type business, where we have a purchase order which is executable over a 2 or 2.5 year type of time horizon. And finally, on the engineering side of the business, again, here they vary depending on the engagement model. There may be fixed price contracts. There are service centers or delivery center models where you may have typically a slightly longer horizon of maybe 6 months or so. And then you have time and material kind of programs where, again, the purchase orders are shorter in nature, but these are typically recurring business, and we continue to work with them over a longer horizon. So that's 5-6 year type of long-term contracts are unique. I would say it's more in the kind of maybe build to spec kind of projects where we work with very specific customers on this type of forecast.
Correct. One last question, if I may. So the revenue contribution from the industrial segment has increased from, if you compare 9-month basis this year as compared to the last year. So you could, if you could highlight the major drivers of such growth in the industrial segment, like which pockets are, contributing to the good set of numbers in this segment?
Yeah. Fundamentally, as I mentioned in previous calls, we've added a couple of customers in the last 2 years or 3 years in this segment. Fundamentally around, for example, grid automation or for utility kind of applications, which is a global OEM that is sourcing for us, not only for India volumes, but for global volumes now. Apart from that, we also added another customer in the hydrogen fuel cell space, which they're basically pursuing a China Plus One strategy and have chosen us as one of their strategic partners for it. So this is another area that we've seen a good ramp up of growth. So I would say these are some of the top ones. We continue beyond this to see various other opportunity pipeline from these customers as well as other new customers as well. So basically, around broadly the theme of electrification, clean tech. So.
Correct. Great. That was very helpful, and thank you so much, and all the very best for the subsequent years. Thank you.
Just to add a little bit on your previous question, what we focus is customer relationship and customer stickiness on a long-term basis, whether it is a EMS business or a BTS business or a ER&D business. What happens is, in business like EMS, where the customer has a longer visibility for 12 to 15 months, they will be able to give us firm orders plus the forecast. But in case of engineering R&D services, it is the relationship that matters. The orders may be long only for next 3 to 6 months, but they get renewed at the end of 3 to 6 months. But in the case of BTS, like the package solutions, passenger information solution, what we do is we develop the product for the customer, and on the successful implementation of it, they will issue us probably a letter of intent for a longer duration, and it will be sourced from us only for the mass production. So the fundamental factor I want to insist is, it is all about the customer relationship, and we have a strong relationship with all our top customers who have been with us for the past 10-15 years. So that is the most important thing that I just wanted to add to what Nikhil said. Thank you.
Thanks, Jessica. And I would add on to that also. I would say in the sectors that we've chosen to be, the products themselves that we are delivering to these customers have very long life cycles. Right? Their life cycles can be 15, 20 years quite easily. So, while the firm purchase order or forecast may be for a 12 to 18 month period, the business itself, including the product deliveries, happen for a very, very long time.
Thank you.
Correct. Yeah. Thank you so much.
Thank you very much. A reminder to all the participants, you may press star and 1 to ask a question. Thank you. The next question is from the line of Mahesh Agarwal from Agarwal Family Office. Please go ahead.
Hi, Nikhil and team. Am I audible?
Yes, sir.
Congratulations on a good set of numbers, and it's good to see the recovery come along. The first thing I wanted to understand was if you could just speak more on the EMS side. Obviously we are not like a Dixon or a number kind of EMS player that's focused on the higher volume, lower margin consumer electronics. We're more along a Kaynes or an Avalon. So if you could speak a bit more of our specific capabilities in the EMS sector and how we potentially maybe compare to a Kaynes or an Avalon or a Syrma. And then also what the outlook is for the EMS sector, specifically both domestic orders and export orders, and what opportunities we're focusing on over there.
Yeah. Thanks very much. The question was regarding the EMS pipeline and positioning. So yes, you're absolutely right. The kind of segments that we are targeting are basically around aerospace defense, industrial, mobility, and medical. Right. So these are fundamentally the areas that we are in. I would say we have a very strong relationship. I would say one key point in a lot of this is our EMS business today is majority export oriented, and fundamentally that essentially means that the quality requirements, expectations from our customers and what we are able to deliver in terms of these products are world class. I think that's one unique differentiator when it comes to this segment in terms of our existing deliveries, customer relationships, and all of that, which Jessica already mentioned. In terms of the pipeline itself, I would say multiple different things. I think with our defense, starting with defense and aerospace, which is the significant contributor even in the EMS segment. We do see existing customers itself having higher spend, essentially because of the ongoing wars, whether it's Russia, Ukraine, or Israel, or the war in Gaza, basically, which we see potential for more export opportunities. Apart from that, we are also seeing some new geographies, the Middle East also, where there seem to be an increased demand, and we are working with new customers in that space as well. Apart from that, on the industrial side, as I just mentioned, we are continuing to see new customers come in, as well as with existing customers itself. Just to give you an example, I talked about this one customer we added, which is a global OEM in the power grid industry, grid automation, basically. And we have established a strong relationship with them over the past couple of years, now we are now a single source supplier for a couple of key products, the broader product line that they have. And what we are seeing is new pipeline of opportunities coming from these customers as well. So our share of wallet from some of these existing large customers can continue to increase, and we are seeing our efforts in terms of mining these existing customers starting to come along in the form of our pipeline itself. Apart from that, we are also seeing some exciting opportunities on the mobility space. Again, driven by both electric vehicles as well as other, traditional auto electronics kind of opportunities, even for export customers as well. The themes around the China Plus One and the Make in India continue to persist and drive opportunities from global players essentially trying to set up supply base in India.
Understood. Thanks. That's very helpful. If I can just double-click on the China Plus One opportunity that you've been talking about, how would we as a company or as a country today stack up to the quality that China is able to deliver, and what would be the price differential that we have to catch up with China? Like, how much cheaper are they still today?
Yeah. So first of all, on the quality aspect, I think this is where, I was just with some customers, in fact, this week, where perception of quality, I think once we start engaging, is quite high. At least I can speak for Centum, we are compared not at the quality level of China, but at the quality level of Switzerland or Europe, basically, or the US, right? So I think from a quality perspective, absolutely we have the right talent, the right processes to be able to deliver world-class quality. Secondly, from a competitiveness standpoint, here again, I think there's a combination of two. You have the material cost itself, and then your conversion or your value add, essentially, right? So from a value add, which is primarily a labor cost driven factor, we are able to be competitive, right? So that our rates and so on are competitive. We continue to improve on productivity kind of measures in terms of digitization, automation, all of that, which will help drive. On the bill of material itself, there are, again, different aspects of this. There is semiconductor driven costs, and then you have your other costs, which are PCB and electromechanical kind of components. So in this case, we do see that China still is more competitive just because of the capacity and the economies of scale that they have established. But with all the different measures that are being driven by the government, we do hope and we do expect that the competitiveness will slowly come from an Indian supply chain itself. But for now, we are able to compete simply because we are able to still buy from China. Some of these BOM items which are still competitive to buy from there.
Understood. And on the purely just research and design side, would it be fair to say that we as a country, you as a company, have a slight edge over China, given maybe historically India has been much better in the IT domain, on the engineering services, and potentially does the language barrier with China versus India being a more English-fluent country, does that also help with winning some of these orders and customers versus a Chinese company?
Absolutely. In fact, for us, we've seen, we're speaking with a couple of, again, large customers that we are in advanced stages with, where one of the key factors for them is obviously the availability of good engineering talent as well. Because again, the kind of products that we're doing require, that engineering strength. And our synergy in terms of offering all these engineering service along with our EMS kind of business. Just to give you an example, there are certain products where when a product is transferred from an existing supplier to us, we are not only just manufacturing the same product, but we are also able to offer the customer value-added service in terms of managing obsolescence of components by redesigning the product for them, or perhaps upgrading the performance of a power supply unit that goes into the broad, bigger box build that we're supplying to them. So these are all specific examples where it's not just a simple build-to-print transfer from one place to the other, but really a engineering-driven value-added value proposition really that we're able to make to the customer, right? That's one. And I would say another point also is a lot of these customers also have their own captive centers here in India. And the proximity to their own engineering, design and captive centers is also another big advantage that plays in their mind when they choose the supplier. So.
Understood. That's very helpful. And sorry, if I may ask a last question, what would be a scenario when someone would engage with us on the engineering and design side?
To that, I think Nikhil explained very, very, very well. If I were to summarize on this China Plus One, on the positive sides, like what you also, indicated, the language, the engineering talent, and the quality, like what Nikhil explained, and the cost on the value add side, other than the material cost. These are all positive points from the perspective of a customer who wants to come to India, and we rank very high on all of those. The real challenge is all about the bill of material, like what Nikhil explained. Challenges, in terms of bill of material, Chinese costs are still probably slightly cheaper. So that we are trying to work on with one, localization, where whatever possible that we can do the localization. And the local ecosystem is still developing. And the second is like what he mentioned, the redesign engineering services by which you improve the bill of material. And the third important factor, still we are able to procure from China. So these are all the risk mitigation on the challenges that we have on the material cost. Overall, the positive sides of coming to India weighs much more than the perceived little negative side of the same. I just thought I'll quickly summarize it for your sake. Yeah, please continue.
That's very helpful. That's very helpful. Thank you. And then, sorry, just the last question. What would be a scenario in which...
Mahesh, can you rejoin the queue?
Sure, I'll come back in the queue. Thank you.
Thank you. Thank you very much. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we will request you to rejoin the queue. Thank you. The next question is from the line of Aditya Chheda from InCred Asset Management. Please go ahead.
Hi, morning, Nikhil. So, my first question is on the strong ramp-up in the revenue we've seen in the standalone business. We had highlighted about onboarding an MNC customer for EV and another customer in US for hydrogen fuel cells. So are we seeing these orders contribute to the top line, or we are yet to ramp up from these opportunities in our revenues?
Yeah. So simply put, I think in this year, the increase that we have seen in terms of the revenue growth has come largely from the EMS segment itself, where the growth has been driven by these new customers in the industrial or fuel cell kind of business, electrification business, and the e-mobility space. So absolutely, they have been contributors to the revenue growth that we've seen this year. And as I mentioned, we see new customers as well in these segments that we are also working in advanced stages and hope to ramp up in the coming years.
Right. An extension is that the incremental growth predominantly should be from added wallet share with these customers or adding new customers in with similar work profile. And second, on the manufacturing capability side, you would have already started delivering these orders. So do you see scope of adding some manufacturing capability in anticipation of incremental orders for these orders? Yeah, these are my questions. Thanks.
Yeah. So the first question with regard to wallet share and new customers, I think clearly at this stage we are seeing both as very good and strong opportunities for growth. So having said that, we're not going after every customer that comes our way. We want in the EMS business especially to have customers that can give us a sizable volume, at least a $5 to $10 million kind of engagement is what we look for with new customers. So we look for that when we're adding new customers. But having said that, there is a healthy pipeline of opportunities with new customers there that we see scope to achieve that kind of engagement level. These are large companies, globally speaking. And of course, with our existing customers itself, especially where there is a synergy with regard to their own strategies of Make in India or dual sourcing from China, we pitch ourselves there, or even, for example, offset as a driver on the defense side. We pitch quite strongly to grow there. So definitely both sides of it. The second question with regard to capability enhancement on the manufacturing side or capacity, here, yes, with the kind of products that we build, with the kind of customers that we're engaged with, we many cases have to add some special processes for the products that we're making for them. We have a strong engineering and NPI team that is well trained and have the right processes in place to be able to absorb these new technologies. So I won't get into what specifically, but we every year have new processes that we add into our overall manufacturing capability portfolio. So it's something we continue to do. And from a capacity standpoint as well, wherever we have bottleneck stages, we are investing in adding that capability. So I would say in general, to answer your question, I think as a company, we have probably one of the best and most broad-based capability from a manufacturing standpoint in the country, ranging, even going into microelectronics, packaging and so on, where which is a very unique capability we already possess. So we have that, and then we add the capacity wherever we are able to find a customer that needs it.
Great. That's it from my end. Thank you.
Thank you very much. The next question is from the line of Chirag Kacharia from Ashika Institutional Equities. Please go ahead.
Yeah. Thanks for the opportunity again. I have one follow-up question with respect to that Indra MOU. Which other players also bid for the same project? If you can highlight a name then. Yeah.
Yeah, I mean, these are limited tenders and so on. I mean, you would imagine who the other typical players in this kind of business are in terms of radars and so on. So you have Astra Microwave, you have and other large OEMs like L&T and so on that have participated. So we will continue to watch for how this evolves. So.
And any other similar opportunity in pipeline which we can expect, like going forward in the year, we may announce something on big side?
Yeah, we are obviously following various opportunities, broadly in the electronic warfare, radar, and space domains. So we continue to follow those. I don't want to comment too much about it because obviously the timelines associated with the procurement processes are unpredictable.
Absolutely.
So we are following them closely. There are significant opportunities. Timelines are still a little bit uncertain.
Okay, thank you.
Thank you very much. The next question is from the line of Mehul Panjwani from 40 Cents. Please go ahead.
Hello, sir. Thank you so much for the opportunity. I have a very basic question because I am new to our company. I just want to understand structurally how the organization has moved because, we have been in existence for 25 years. And all these China plus one, plus the EV opportunity, all these are, I would say that these are last 5 years development. So what is it that, how have we progressed over the last 25 years and how we have found our niche and how we have moved from, how have we moved into different segments like, EMS, BTS and others. And second question is on that, during the other question, you mentioned that we have a very strong relationship with our customers. So I just want to understand the geographical spread of the customer. Is it in North America or also in Europe? So these are my two basic questions. Thank you.
It can be a very long answer to talk about our 30-year history. Actually, this year we turned 30.
Congratulations.
It's really been a long and good story for us. The company started as a single product, single customer, single geography kind of story when it was founded back in '94. But over time, the strategy that's been pursued for the development of the company has been really to diversify that in different ways. Right from the early days, geographically speaking, we've started to export. And that's been one of the reasons or ways by which we've been able to develop very strong relationships with these global customers, right from that have been long-standing customers for us. So today, if you look at our geographic spread in terms of revenue, little more than 50 to 55%, or 50 to 60% of your revenue comes from Europe, about 15% or so from North America, and then Asia is about 30% roughly, and India itself is about 20-25% in that. Going forward, just to complete on the geographic point, with all of this changes happening, we do see demand from India itself increasing significantly. So that's one. And then the other thing in terms of what's been the guiding principle for us in this development journey or the growth journey over this last 30 years, I would say, is really to be a technology-driven player. Even whether it's manufacturing or design, idea is really to focus on creating value for the customers, creating differentiated value for the customers, and delivering world-class performance and quality in terms of our products. So this is one of the reasons that while we started with a very specific, narrow kind of product, we've added new services and products to our portfolio, which are high technology, high complexity, or differentiated products with higher entry barriers. So I hope that generally answers the principle.
Sir, one follow-up. Thank you, sir. One follow-up question. So you said we have started in 1994. So when was our first export order from Europe or America?
95, yeah.
Also, pretty much we have been an export house from the day we started.
Yeah. Actually, just to add on to that, we always thought that we should be a global company and we want to be an international company. So when the company was started, it was for a telecom market, like what Nikhil said, and we exported telecom components to Europe in the very second year, I would say.
Right.
That has always been our focus.
Right. And sir, so how much of, let's say, assuming that the China Plus One wouldn't have happened and the EV demand wouldn't have been there, for example, and we would be still doing what we have been doing for the last 30 years, then, can we say that these are really very good tailwinds for our business, the China Plus One as well as the the electric vehicle businesses?
Yeah, I mean, it absolutely. I mean, I think the kind of just to answer the question very simply, I would say 5 years ago or 10 years ago, the amount of effort that we had to put in to go and convince a customer to source electronics from India was significant. We had to really prove and demonstrate and sell and work very hard to get a global customer to buy from us. Whereas today, the customers are coming to us because they are driving them to find companies like us to source from. So it is clearly a fundamental shift in the global supply chain.
That is really encouraging, sir. One last question, which is a follow-up one. So are we competing with any international companies, like companies in Israel or companies in America itself or in Europe, or we are just competing with the local companies in India? I mean, for the export orders.
Yeah, we always compete with global players. If you look at any of our customers, they are large global companies. They have strategic suppliers and partners that are global in nature or in other geographies basically. So in many cases, in fact, our customers don't want to have more than one or two suppliers in India. So most of the time we are actually competing with players elsewhere.
Right. So can you please name few of your global competitors?
So if you look at the kind of segments that we are in, you will see companies like Plexus. If you're talking about EMS, again, the competition varies very significantly because there's not one company that does EMS, engineering services, and VTS, right? So the competition is quite varied depending on who you're referring to.
Right.
But if it's based on the question regarding China Plus One and all of that, if you're talking about EMS, just to say a few competitors, it is companies like Plexus or in certain cases, Sanmina also, which has a presence in India, or Benchmark Electronics, Astiel Flash. These are all different venture technologies. These are all some names of companies that are based either in Europe or other parts of Asia that we compete with.
Right. So one last question. So for all these three...
Mehul, can you rejoin
Thank
the
you
queue
so
for
much.
follow-up question? Yeah.
Thank you, ma'am. Thank you so much. Yeah. Thank you, sir. Thank you so much. Yeah.
Thank you very much. The next question is from the line of Nimish Gupta from Nimish Gupta and Company. I request all the participants to limit their questions for one per participant. Please go ahead, Nimish Gupta.
Good morning, sir, and congratulations for a great set of numbers. My voice is audible?
Yes.
Okay. So, sir, I have two basic questions, sir. First is regarding our order book. So, I mean, sir, there is a flattening kind of order book from last couple of quarters. So, I just want to understand, earlier we have given a guidance that there will be a 25% CAGR increase year over year in the order book. So, like by year end, can we see a 25% kind of increase in order book in current year and by the next year?
As I mentioned earlier, order book is one thing. It's the three different segments, EMS, BTS, and engineering services, have different horizons of order execution, first of all. That's something I mentioned earlier. So the order book itself may look like it's flattening, but it can be as a result, as I mentioned, with certain EMS customers also reducing their horizon of orders from what they were previously doing to today. And also, we do see, as I mentioned, some slowdown temporarily due to an overstock situation with some specific customers. Having said this, our guidance, whatever we talked about earlier, was really at a medium-term basis, so we are not giving yearly, annual kind of guidance. So please don't ask for that. But on a medium-term basis, we are still quite confident of our ability to grow at this healthy rate of 20+%, around 20%.
Okay. And so my another question is regarding our EBITDA margins. So like in earlier calls, we have been we were targeting EBITDA margins of around mid-teens, 15% in next 1 or 2 years after turnaround of our subsidiaries. So can we see those kind of margins by March 25?
Again, we talked about this, so we are the improvement in margin will happen in a stepwise manner. We said that this year we would close somewhere close to 10%, and we'd move that up to a 12%, kind of range in the following year and take it up further from there. So we see our plans are in place to work towards that. That's what we see as a visibility right now.
Sure, sir. Thank you, sir. Thank you.
Thank you very much. In the interest of time, we'll take that as the last question. I now hand the conference over to management for closing comment.
Once again, thank you all for taking the time out to be here with us for this earnings call. As you mentioned, we continue to see a strong pipeline of opportunities. The broad themes of Make in India, whether it's in defense or in other sectors, as well as the China Plus One strategy, continue to persist. And based on this, we remain quite bullish about the possibilities to grow in the coming years. At the same time, our focus remains on also improving the margins at the subsidiary level, and we have a clear action plan to work towards that, and we expect to see that contributing positively to the business in the coming quarter and in the next year as well. Thank you once again, and look forward to meeting you in the near future.
Thank you very much.
On behalf of Phillip Capital India Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.